Okay, let's work through this kind of problem from chapter 6. It's important that you understand the relationships of things so that you can be ready on test day. And this is one of the things this is going to test is your understanding of the four different inventory methods. When you do a problem like this, notice and read carefully. List the name of the inventory method that best fits the description. Assume that the cost of inventory is rising. This is the key piece of information that you need to answer these questions. The easiest thing you can do is on scratch paper, go ahead and write what this looks like, what inventory that is rising looks like. I've taken the trouble here to set it up, and you see here we've got a beginning layer of inventory of 1,000 units at $10, obviously 10,000. And then on the 16th, we bought another 500. Notice how prices are going up, $12 now. Notice that on 130, we bought another 600, and now it's up to $14 per unit. So this is a model that shows you what rising costs look like. The question for the first one is, which one maximizes income? In other words, which one maximizes the most income? This is where you're going to have to rely on your knowledge of what we talked about before. Remember we said that, let's see if I can fit it in here. We got revenue, we got cost of goods sold, we have gross profit or gross margin, whatever you prefer to call it. Okay, and revenue minus gross profit, minus cost of goods sold is gross profit. Remember we said that these move together, right? And what these said, these move apart. So when this goes up, this goes down, and when this goes down, cost of goods sold goes down, gross profit goes up, earnings go up. Okay, so we're being asked here, hey, what maximizes, what makes income the highest? What makes this the highest? Well, here we obviously see, we have revenue. Revenue will be maximized, but this is not asking about revenue, it's asking about inventory method. An inventory method has everything to do with cost of goods sold. So the question is, if you want gross profit to be as high as possible, you want cost of goods sold to be as low as possible. Because low cost of goods sold gives you high gross profit, otherwise known as reported income. So we're going to look for a method where the cost of goods sold would be very low. Well, obviously, if you sell from this upper layer up here, it doesn't matter. We don't have to get into specific numbers. You don't have to know what ending inventory is. You just have to know that Fifo, right? Remember, Fifo goes down. It sells in a downward direction. And then with FIFO, what's left, I'll go ahead and put F here. You know what that means. F means you sell, cost of goods sold, the older layers, and you keep this newer layer. Okay, LIFO, coming back to LIFO, does the opposite. It consumes, these are the layers at the bottom that you sell, right? This is where cost of goods sold is consumed, and what we keep is the older layers. In the case of FIFO, with prices rising like this, the older layers have ending inventory would be lower because you're using these older layers, and cost of goods sold would be higher. Okay, and the opposite would be true in LIFO. So let's look at what it's being asked again now that we've kind of set everything up. It says, what maximizes reported income? Well, we want income to be like this. That means we want cost of goods sold to be like this. Okay, well, FIFO sells from these lower valued layers, right? LIFO sells from these higher layers. So if we want cost of goods sold, right, to be as low as possible, that's to jack up gross profit. If we want cost of goods sold to be as low as possible, then we want to sell from these upper, older layers, which that's what FIFO does. So the answer is FIFO. That says the answer is used to account for automobiles, jewelry, and art objects. This is pretty easy. Anytime you're trying to tag individual cars, individual jewelry, individual art, the inventory method that's used is specific unit. So that one's a pretty easy one. Okay, results in a ending inventory, in other words, a cost of inventory that is close to the current cost of replacing the inventory. Okay, so here it's asking you, hey, which one of these methods results in an ending inventory cost that is close to what things actually cost right now? Well, this gets into which of these methods would give you the highest, since prices are rising, which would give you the highest ending inventory. Well, we can tell here the closest, one of the clues we have here is results in the inventory that's close to the current cost. Well, there's nothing closer to current cost in this example than this layer. So if we want ending inventory to be really, really close to what things actually cost right now, we want to keep these newer layers, and we want to sell these older layers. Uh, uh, Lifo sells from the bottom up. Fifo sells from the top down. The top, in this case, has prices, has costs that are lower, right? And don't reflect what things actually cost now, which is 14. And that's what you want. What you want here is you want the ending inventory to be as close as possible to current cost. Fifo keeps these really, really new layers, and it sells these old layers. Hence, ending inventory is closer to current cost. Hence, the answer is FIFO. FIFO, another way to look at this is FIFO is like the way it works is it's almost like selling tomatoes. You know, it sells the oldest ones, right? The ones that have been stocked the longest, and it tends to hold on to the newest ones. And that's what you're doing here. You're basically you're keeping ending inventory close to what it really costs to replace it today. Generally associated with saving income tax. Well, again, let's go back to our example here. If we're trying to save on income tax, we want gross profit to be as low as possible. We don't want it to be as high as possible. We want gross profit, gross margin. You know, that's what you pay income tax on. You pay taxes on income. So we want this to be as low as possible. If we want gross profit to be as low as possible, we want cost of goods sold to be as high as possible. We want what is sold to be as high as possible. Since prices are increasing, Lifo would be what satisfies that. Lifo would sell these more expensive layers. When these more expensive layers are sold, you have a higher cost of goods sold and a lower gross profit. So that's Lifo that saves on taxes. Okay, enables a company to buy high-cost inventory at year-end and thereby decrease reported income uh, and decrease reported income and income tax. Okay, so this is exactly saying, hey, this lets a company um, buy high-cost inventory at year-end. So you're at the end of the year and you're buying inventory that's really, really high in cost. Maybe prices have really gone up. You see this sometimes with oil prices that move up, and wow, they get really expensive at the end of the year. And we've happened to be experiencing the opposite now, where oil prices are collapsing. But this lets a company buy high-cost, expensive inventory at year-end, and through that, lower their income taxes. Again, back to our example, if we want income taxes to be as low as possible, we want gross profit or gross margin to be as low as possible. That means you want cost of goods sold to be as high as possible. Well, when you look at the example as we have it, we have increasing costs, right? We have increasing costs, so if we want gross profit to be as low as possible, we want cost of goods sold to be as high as possible. We want to sell from these bottom layers. LIFO sells from these bottom layers and lowers income tax. Notice this is almost the exact same question as what was asked right above it. Okay, results in an old measure of the cost of ending inventory. By old, we mean the older layer. In other words, what is it? What is the method that results in the ending inventory to not be reflective of what things actually cost? You'll notice this is the opposite of this. This is results in an ending inventory that is close to what things actually cost now. Now we're asking the opposite. Results in a measure of cost in an old measure, old version of the cost. Well, here's our oldest cost, right? And FIFO sells, it doesn't keep, FIFO sells from the oldest to the newest. So if we select FIFO here, what we're going to end up with is we're going to sell these old layers, and then these new layers, right, the ones that were just added at the end, are going to be an ending inventory. So that doesn't reflect, that doesn't reflect an old measure. What's sitting on the books would be the opposite. It'd be, let's say for example, we sold 1,500. We would sell these two layers completely out under FIFO. Then we'd keep this 600 at a $14, which is the current cost right now. Lifo would do the opposite. Let's say we sold 1,100. Lifo would sell these two layers completely out and keep this oldest layer that was added at the, it came in the beginning of the period. So this $10 does not reflect the cost right now. I mean, it'd be an old measure. This is an old measure of what these things that you're buying, because you're buying the same thing here in inventory. This is an old measure of what it actually would be. So LIFO would give you an old measure or an old version of the price. Okay, this one's pretty easy. Provides a middle ground measure of ending inventory and cost of goods sold. Not just ending inventory, but cost of goods sold. Middle ground is almost code talk for average. Enables a company to keep reported income from dropping lower by liquidating older layers of inventory. Well, here we've got the opposite problem here of trying to depress income tax. Here enables a company to keep reported income from dropping. If you keep something from dropping, what you're doing is making it higher, right? So here we are, we're trying to make this as high as possible. We want gross profit, hence income, hence reported income. We want this to be as high as possible, right? We want that means we want to depress cost of goods sold, okay? If we want to depress cost of goods sold, we need to have cost of goods sold be as low as possible. That would mean selling from these older layers that are cheaper up here. So if we're selling from the older layers at the top here that are cheaper and keeping the more expensive last layer, that's the definition of FIFO. FIFO sells, doesn't keep, FIFO sells from these older layers. In this case, prices happen to be going up, so FIFO would result in keeping income from dropping, because we would prop up income. Income would be propped up by the fact that we're selling from these older layers that are cheaper. So come over here, and this is FIFO. Okay, number 9, writes inventory down when current replacement cost drops below historical costs. This is what we were talking about in class about an impairment to the value of inventory. In other words, we thought it was going to be worth 10,000 and it's really worth 6,000, and it's a permanent impairment. I mean, it's dropped, so we're going to have to show the outside world. What's important to know about this is this applies to all 4 inventory methods. Lower of cost or market is not something specific to LIFO or FIFO. It applies to all of them. Matches the most current cost of goods sold against sales revenue. So things sell, right? Things actually sell at a current price, okay? So if things sell at a current price, people don't want to pay you what it was worth a year ago. They want to pay you what it's worth right now. If you're trying to match that current new price against that current cost, okay, you have to ask yourself which one of these methods puts through cost of goods sold the most current pricing. Well, if you come over here, remember LIFO sells from the newest to the oldest, and FIFO sells from the oldest to the newest. So if you're trying to match revenue, if you want revenue dollars to closely match the true cost of what's being sold, you want LIFO. LIFO selling these prices, right? These layers of inventory that are closest to what your next sale is going to be. Okay? If you're using old pricing, it's going to make it look like you're making tons and tons of money. But what that reflects more than anything else is that consumers are willing to pay, whatever. In this case, let's say this thing sells for 22 bucks. You're matching 22 bucks against, the $10, for example. Good example, let's say you sell 1,000, all right? Cost of goods sold, you sell 1,000. If you sell 1,000 and that thing retails for $22, you're matching it up against $10. This is pretty old pricing. However, if you sell it for $22 and you use LIFO, LIFO sells from the bottom up, back to LIFO, you're matching closer to current pricing, right? Current pricing being $22, matched up against closer to the cost that it actually is now. So this is LIFO. That's pretty much what there is to this type of problem. The important thing to note here is what is it saying, okay? Get good with understanding. I think it helps to have the layers. Also be on the lookout. Be on the lookout because you could have pricing going the other way. This could be, let me see if I can make it go the other way right quick. This could be 20, being exaggerative here. This could be 12, and this could be, for example, 4. I know I'm making a mess of this. Well, I'll tell you what, let's do this. Let's just erase the thing. Here you have prices collapsing, right? So if you have prices collapsing, be careful because now it's different. Now with prices collapsing, FIFO, the rule still stands. FIFO sells from the oldest layers to the newest layers. Lifo sells from the newest layer to the oldest layer. So you notice here, if you wanted, let's say we're using this different assumption. Let's say that you wanted income right here. Let's say you wanted income to be as high as possible, right? If you want income to be as high as possible, that means you want cost of goods sold to be as low as possible. So you want to sell from the bottom here, right? You want to sell from the bottom to make cost of goods sold be as low as possible. Lifo sells from the bottom. So notice it's flip-flop now. Now if you want income to be really high, you want to report the highest possible income, you want to use Lifo. In reverse, let's say for example you want to save on taxes and you want income to be as low as is possible. Well, in this collapsing price environment, you want to sell you want cost of goods sold to be as high as possible, right? Cost of goods sold is high, gross profit is low. If cost of goods sold, you want it to be as high as possible. In this scenario, you want to sell these layers at the top that are more expensive. FIFO sells from the older layers to the newer layers. In this case, it happens to be higher. So just be flexible, be ready. If you set it out like this and ask yourself, which way does FIFO sell? Which way does Lifo sell? You should be just fine on a problem like this. Practice makes perfect, and that's what I encourage you to do on these. I hope this helps.